Okay, chapter 5, where we're talking about merchandising operations. So far, everybody that we've talked about in chapters 1 through 4 has been a service business. And so now we're going to talk about merchandisers. And we talked a little bit at the beginning about 3 different types of businesses: services, merchandisers, and manufacturers. And so a merchandiser is somebody who sells stuff, goods and services, mostly goods, not services yet. So sells goods or merchandise that somebody else produced. So a manufacturer would have produced it. So this would be, Target, the grocery store, any clothing store. They don't manufacture themselves. They buy stuff and then they mark it up and resell it. That's what a merchandiser is. And the 2 main types of merchandisers are retailers and wholesalers. A retailer sells to the end consumer, and a wholesaler is a middleman. They buy from one business and sell to another. So they'll buy from the manufacturer and sell to the retailer, for example, and they perform various services in there, but that's basically what they are. And a lot of what we'll be talking about in this chapter, we kind of assume that's what we are. Business to business transactions are really very huge, and as consumers we kind of forget about that part of it. But like if you work for a restaurant, for example, the people that bring your food supplies, that's probably a wholesaler. They sell just to other businesses like restaurants rather than to the end consumer. So we have a couple new accounts that we haven't seen yet. One of them is sales revenue. So a service business, they call it service revenue. Now we're selling stuff, so we call it sales revenue. That is obviously a revenue account. Another big one we have is called cost of goods sold. I'll generally abbreviate that COGS. That is an expense account. So far, every expense account we talked about has the word expense right in the name. This is the one that doesn't. So this is an expense account, and for a merchandiser, this is the biggest expense account. This is pretty huge, and so we'll talk a good bit about that specifically. So these guys go in the income statement, and then we have another new account called merchandise inventory. And this is the inventory that I have, either on the sales floor or in the stock room or whatever. This is an asset, so it goes on the balance sheet. The inventory, because it's such a big cost, is very, very important. So we spend a good bit of time talking about that because that is the major expense for a merchandiser, and so how they handle their inventory can really make or break them. We have kind of another concept here called gross profit. So the sales revenue is, if I'm the merchandiser, this is what I sold it to my customer for what I sold it. That's probably not a good way to say it. How about what I charged the customer? Charged my customer. Cost of goods sold is what I paid for it. So I bought it for $100. I turned around and I sold it to the customer for $150. So the difference between what I sold it for and what I paid for it is called gross profit, which is another important number that we really need to pay attention to if we're a merchandiser. You could think of that as the markup, right? The difference between what I paid for it and what I turned around and sold it to my customer for. So with these new accounts, we have some differences in our income statements. Here is what we were used to seeing over here in the service company, just revenue minus expenses. Now over here with the merchandiser, it's a little bit different. So I take the revenue minus my cost of goods sold, and remember that is an expense, but I'm going to treat that different than the other expenses. So this gives me gross profit. Then I subtract off all the other expenses, which I call operating expenses, and to get the net income. So you have the same net income, but I break it into these steps because as a merchandiser, this gross profit number is really important for me to see. Again, that's my markup. And so if the gross profit is too low, then maybe I need to increase the price I'm charging, or maybe I need to find a way to reduce my cost of goods sold. But then if my gross profit is healthy, but my net income is low, then that says I need to look over in here. So into my operating expenses and see where I can cut some expenses there. But this number, my gross profit tells me how well I'm doing on that markup. So that comes in a very important number for them to watch. The balance sheet pretty much looks the same. I've just added this merchandise inventory, which is a current asset. Nothing else on the balance sheet changes. The liabilities and equity section look exactly the same. So let's talk about this merchandise inventory. And we'll actually talk about that in the next chapter as well. So we have two inventory systems. The first one is called a periodic inventory system, where I essentially figure out how much I have by doing a physical count of the inventory. When I do my financial statements, so when I go back here at the end, I kind of back into that number. I kind of say, all right, here's what was here, here's what I still have. I do a physical count, and the difference must be what I sold. This will work if you're very small. Maybe if you're a restaurant and you don't have a lot of like inventory because it's food. But if you have a lot, what you really need is what we call a perpetual inventory system, and this is what most people use. So you keep a running computerized record of your inventory. A periodic system, they'll just go through at the end of the year and count what they have and figure out what they bought during the year minus what's still here from this physical count, and that's what our cost of goods sold is. But the perpetual inventory system, they keep a running count of that cost of goods sold after every sale. If they have a barcode that they are scanning, like at the grocery store or Target where they scan them, then they're using a perpetual inventory system. And so this allows me to track in real time all my purchases, so what came in and what it cost me. So not just the number, but the value of that, the cost. All my sales, what went out, and then the quantity on hand. So what's still here. So at any time, I know what came in, what went out, and what's still here. And so I can have much more accurate records of what's selling well, when I need to restock, what's not moving that I don't want to reorder. And so, again, if you have a very small store, the periodic will probably work. You know what's coming in and going out, and especially like if you're the only person working there, you've got to probably get a really good feel for that. But that would never fly at a larger retailer. They need this computerized system so they can monitor what's coming and going and what's still here and when I need to reorder. So they'll still have to do a physical count, probably once a year to charge them. But if you see them if they're scanning barcodes, then it's a perpetual inventory system, which is what we will kind of assume for the rest of the chapter. So recording purchases. We're going to record purchases first, and then we'll talk about when we make sales. So now I'm buying inventory for my store. Then we'll talk about what it looks like when we sell it, and then we'll kind of put them together. So when I'm recording purchases, again, for any of these transactions in a merchandiser, I think it's helpful to picture what's coming in and what's going out. So if I buy merchandise, that's what's coming in. I have acquired this inventory, and so I debit the account merchandise inventory. It's an asset. A debit will increase it. And then if I bought it, I would say cash is going out. Or, and this is more likely what you're going to see, you debit merchandise inventory because you bought something, and so it's here, so that asset goes up, and then you buy it on account, so the credit would be to accounts payable. That's really more likely what you're going to see. Most of the transactions we're doing we're talking business to business, and they almost all buy on account, and you'll see why here in a minute. So here's what it looks like when I make my purchase, and then 2 weeks later, so they send it to me with an invoice, and then I pay it, and so I debit accounts payable and credit cash when I pay for it. And that looks exactly like it did in the first 4 chapters. There's no difference with this one. It's just the purchase of the inventory is a little different, and then I debit accounts payable. Now, again, like I said, almost everybody's going to do it on account, and one of the reasons, it's just very common in business to business, but we also have here a seller will offer purchase discounts. This is really an incentive to pay early. So they might say, okay, I'll invoice you and you have 30 days to pay it, but the seller would really like to get paid sooner, and so they might offer a discount if you pay early. So what you see it is something like this. It'll be like 210 net 30, which means you get a 2% discount if it's paid within 10 days. Otherwise, the balance is due in 30 days. So that's what this one would look like. You might see 3.5 net EOM. That would mean a 3% discount if it's paid within 5 days. Otherwise, the balance is due at the end of the month. That's what EOM does. You could have 3.15 net 60. So you'd get a 3% discount if it's paid in 15 days. Otherwise, the balance is due in 60 days. So these credit terms are agreed to at the beginning of the sale. You know, often it's kind of what's common in your industry. Everybody's offering the same thing. So this is what the journal entries would look like. When I initially purchased the inventory, I'm going to debit merchandise inventory. Let's say I bought $1,000 worth of stuff. And I'm going to credit accounts payable because I haven't paid for it yet. $1,000. Now, if I turn around and pay that, and let's say I pay it in 30 days, and so I paid for it, but I don't take the discount, I would just debit accounts payable, $1,000, and credit cash, $1,000. Now, let's say I paid for it and I took that discount. So I paid it in the 10 days. So I'm still going to debit accounts payable, and I'm still going to credit cash. But if it's $1,000, it's $1,000. I don't want to write there. It's $1,000, and I took a 2% discount. That means I got a discount of $20. So I owe $1,000, but I'm taking this $20 discount, so what I'm paying is $980. So the cash I'm paying is $980. But I have to credit accounts payable. If I credit accounts payable for the $980, my credits and debits would equal, but that would, my accounts payable balance would be showing that I still owe $20, but I don't owe $20. So if there's $1,000 sitting in accounts payable from this one, then I need my debit to accounts payable to be $1,000 to show that I don't owe any more money. But the cash I paid was $980. So the difference, I need my credits to equal my debits. The amount of the discount is a credit to merchandise inventory. So I'm bringing the balance down by the amount of the discount. And so what we see now is here, let's change to this one. Here I debited merchandise inventory by $1,000, and now I'm crediting it by $20. So the balance in merchandise inventory will now be $980, which matches the cash I paid. So I want the balance in merchandise inventory to be showing what I paid for it, what I actually paid for it. So if I took a discount, I need to bring the balance down to show that discount so that the balance in the inventory matches what I actually paid for it. Another thing you'll see is sometimes we have to end up returning stuff. And so these are fairly simple. Let's say I purchased it, right? And so I'm going to debit merchandise inventory for $1,000, and I credit accounts payable, $1,000. Now I return part of it. It was defective, or it wasn't what I ordered, or something like that. And so I return part of it. So the return is just the flip-flop of the purchase. So because I returned it, I don't have it anymore, so the merchandise inventory needs to go down. And because I returned it, I don't owe that money anymore, so the accounts payable needs to come down. And so that means I will debit accounts payable. That's a liability, so debiting it will bring the balance down. Let's say I returned $200 worth of stuff. And then I will credit merchandise inventory. That's an asset, so crediting it will bring the balance down. And so now I've reduced the account that shows how much I have, because that stuff's not here, and I've reduced the account that shows how much I owe, because since I don't have it, I don't owe that money. So now, if we look at it this way, here's my accounts payable. Oops, I don't know what that was. And it doesn't want to erase either. That's a little odd. Sorry about that. Let me see if I can get that to go off. No. Okay, I'll try to go back and fix that later. But for now, let's go here. So I credited, oh, there it goes. Okay, that's weird. $1,000 right here. And then I debited accounts payable $200 right here. So the balance right now that I owe is $800. That's how much stuff I still have, so that's how much I owe. So then let's say I paid it and I took that discount, so paid with discount. And we said the terms were $210, net 30. Did it again. And so I'm going to debit accounts payable, I'm going to credit cash, and I'm going to credit merchandise inventory. The journal entry will always look the same. It's just a matter of figuring out the amounts. So that's accounts payable. So there's $800 sitting in accounts payable. So that's what my debit needs to be, show that I don't owe any more money. The discount, the 2%, they're only going to give me a discount on what I still have, right? They're not going to give me a discount on $1,000 if I only have $800 worth of stuff. So the discount will be the $800 that I still have times 2%. So that's $16 is the credit. So what I have to pay in cash is that $800 minus the 16 discount. So I'm paying $784. And if we track our merchandise inventory account, hopefully I can fit this on here. I debited $1,000, then I credited $200, and then I credited another 16. So the balance, I can't write underneath there, will equal 784, which matches the cash that I paid. Because again, I need that account to show what the value of I actually have is here. So minus discounts and minus what I returned and all that stuff. So here's just a little summary. We can see here's the purchase, here's the return, and here is the paid within the discount, net of return. And so you can see that our accounting balance, keep in mind that this is an asset, this is a liability, and so we can kind of try that. That's an example out of your book. The other thing that we have in to worry about with purchases and as a seller is transportation costs. And so you see something called FOB. And this is what tells us, I think it means free on board. I always heard freight on board, but I think your book says free on board. But anyway, this tells us when the buyer of the merchandise takes ownership. So you see two things. You see FOB shipping point and FOB destination. So FOB shipping point means this tells us when the owner. So the owner takes possession as soon as it goes into shipping, as soon as it leaves the warehouse or gets to FedEx or whatever who's doing it. So the buyer takes ownership as soon as it goes into shipping. If I see FOB destination, That means the buyer doesn't take ownership until it reaches its destination. So if I'm the buyer, I don't own it until it arrives at my store. It reaches destination. So what that means is that if it's FOB shipping point, the buyer takes ownership as soon as it goes into shipping, which means the buyer owns it during shipping. So even though I don't have it yet, I still own it, which means it's I'm responsible for it during shipping. It also means then that the buyer pays the shipping costs because I own it during shipping, or the freight cost. If it's FOB destination, the seller owns it during shipping, which means if it gets lost or whatever, they're responsible for it. And that also means that the seller pays the shipping costs. So if I'm the buyer and I am responsible for the shipping costs, I include that in that asset merchandise inventory. I don't have a separate account for shipping. If I am the buyer, I just add it to the merchandise inventory. So that the inventory, so you know how like if you buy something from, I don't know, let's say you buy it from Amazon and you don't have Prime. You'd get the bill and it would be like, here's the merchandise plus here's the shipping, so here's the total that you owe. And so that's exactly what this would be. And so the total that I want to put in an inventory is that total cost, that it would include the shipping. Just the way it's the total cost to you is, it is, it doesn't really matter to you whether it's part of the shipping or whether it's part of it. That's the total, the bottom line to you, and that's what the seller wants to include too, is just the bottom line of that merchandise, including the shipping. So the net cost of inventory, the number I want my merchandise inventory account to be showing, is the purchases minus any returns or allowances. An allowance is something like, let's say I bought eggs and they were broken. Well, they don't want me to return broken eggs, right? They would just kind of knock something off the price for me, like if you bought something that was damaged, and they can say, well, you can go ahead and keep it, I'll just take whatever off the price. Or sometimes they offer trade allowances or discounts for purchasing in bulk or something like that. So it's something that reduces the price you paid. So purchases minus any returns and allowances, minus any discounts I took, plus any freight charges, freight in, we'd call that, would give us the net cost of purchases. That's what I want the balance of my merchandise inventory account to cost. So and I know what is the net cost of getting that merchandise here. You see freight in, and you see freight out. Freight in is the cost for me to get it here. Get it here. And I just add that to merchandise inventory. Freight out is the cost to deliver it to my customer. We'll talk about that when we when we're the seller, and we'll handle that just a little bit differently on there. But for now, freight in, the cost to get it here, I just add that to merchandise inventory. So I want to do two problems out of the demo problems here for you, just to see that, and then I'll stop this video and we'll do a separate one for the sales. So in this one, we've got 3 different transactions here for Party Time Toys. They buy stuff, then they return stuff, and then they pay the amount due. So we're going to journalize these and figure out what is the total cost of the inventory for them. So on the 8th, I buy 141.8 worth of stuff, and the credit terms are 210 net 30. So I debit merchandise inventory. That's the asset that's coming in, right? And so that's 141,800, and I bought it on account, so I credit accounts payable. 141,800. I'm going to do 2 T accounts up here. I'm going to do one for accounts payable. I'm going to do one for merchandise inventory. And so I debited merchandise inventory, 141.8, and I credited accounts payable, 141.8. Then on the 11th, I returned some of that. So remember, the return is just the flip-flop of the purchase. So I'll debit accounts payable, which will bring that balance down by 14,100, and I'll credit merchandise inventory, which will reduce that by 14,100. And so now I debited this, 14,1, and I credited merchandise inventory, 14,1. So now it's time to pay. So how much do I owe? Well, the accounts payable I credited, and then I reduced it by the amount of the return. So the balance in there, is 127.7. That's how much I owe right now. So on 10/15, when I pay this, I need to debit accounts payable for 127.7. They're going to give me a 2% discount. So here's my 2%, but it's going to be of what I still have. So the discount is going to be the 127.7 times 2%. So that should be 2,554. That's the amount of my discount. So I know I'm going to credit cash, and I'm going to credit merchandise inventory for the amount of the discount, which is 2,554. So my accounts payable is 127.7, but I'm taking a discount. So the difference between what I owe and the discount is how much cash I'm paying, and that is 125,146. Now I credited merchandise inventory 2,554. So the last question says, how much did the inventory cost? So I have my purchase of 141 minus my return minus my discount. So the balance in merchandise inventory is 125,146. And so now you can see that the balance showing in the inventory account matches the cash that I paid. So the inventory is showing what I actually paid for it. So let's do one more here. It's very similar. I'm buying inventory. In this one, it's FOB shipping, so I had to pay the freight. But in this case, they are sending a separate charge for this, so they didn't just include it. So the freight charges, if it's FOB shipping, sometimes the seller just pays it up front and then adds it to my invoice. And sometimes I get a separate bill from the shipping company. That's what I'm seeing here is a separate bill. But keep in mind that they will not offer you a discount on the shipping. I'm gonna put that back here because this is kind of important. If it's FOB shipping, the discount will not include the shipping. No discount on shipping. So if you get one invoice that is for both, that includes both the inventory and the shipping charges, when you figure out that discount, you need to back out the shipping because the discount is only on the merchandise. I'm sure there's one of those in the homework, so you'll see that when you get in there. So in this one, so on June 2nd, let's go back to the pen. June 2nd, I'm going to debit merchandise inventory for 23,000 and credit accounts payable 23,000. Then I'm going to pay the shipping charge, and remember the shipping, even though I'm paying like, I don't know, FedEx or Speedy Delivery or whatever, I still debit that to merchandise inventory. So that's 110, and I would have probably just paid cash on that one. I just paid that bill. Then I returned stuff. So that was the 4th. On June 8th, I returned stuff, which again will look the opposite here. So I'll debit accounts payable to reduce that, and I'll credit merchandise inventory to reduce that by $6,200. And then it's time for me to pay it. So on June 14th, so let's see, I owed $23,000, my accounts payable, and then I returned $6,200 of it. So the amount that I still have is $16,800. That's what's sitting in my accounts payable right now. So my debit to accounts payable will be for $16,800. And then we know we're going to credit cash. We know we're going to credit merchandise inventory. I always figure out the discount first. So they'll give me a 2% discount. Here's my credit terms. 2% if I pay within 15 days. But it's only on the stuff that I still have, right? They're not going to give me a discount on the whole 23 if I don't have that. So 2% of $16,800 is $336. That's the amount of my discount. So that's the credit to merchandise inventory. And so the difference between the $16,800 and the $336, that's how much cash I'm paying. And that is $16,464. So now how much was the inventory? The inventory was the $23,000 I bought, plus the $110 shipping, minus the $6,200 return, minus the $336 discount. So discount, return, the freight or the shipping, and this was the initial purchase. So the net cost of my purchases comes out to $16,574. And if we take this back to cash, $15,574 equals the cash I paid here plus the cash I paid, that's 110. The cash I paid here. So now the inventory balance is showing the total that I actually paid. So that's pretty much what we have on the purchasing side of it. So I'll stop this video here, and then we'll come back and talk about what it looks like if we're the seller instead of the buyer.